DKE really traces its history back to 1950, where Dale K. Earhart, who was the founder of the firm, started managing money for other members of his family. He had learned investing techniques when he went to Colorado College after the war. He'd been a flyer in the South Pacific in World War II, came back under the GI Bill, and teamed up with Dr. Lewis Abbott at the Colorado College, and he was taught covered call writing techniques. And so he employed covered call writing techniques for his own portfolio and then for family members starting in 1950 and became quite successful. He'd sell a call option contract to another party where he would agree to sell stock that he already owned at a particular price above the market at some point in the future. And at that time, it was just a date agreed upon. And for that right, the buyer of the option paid him cash. So if the stock didn't get up to the point where they had agreed to sell it, he would just keep the cash. So it was a cash flow strategy. And he became, in fact, the largest option writer and market maker for options for AT&T stock in the country. Dale started his career in the Northeast, New Jersey, New York area, and then moved with his family actually to join with his in-laws who had settled in Venice, Florida, which is on the southwest Gulf Coast. So in 1966, he moved his family and began practicing there just as a manager for himself and for his family and a few friends. He became known as an investment guru of sorts at the time and was in fact invited to join the A.G. Edwards firm, who was opening a branch in Venice, Florida at the time. So he practiced with A.G. Edwards for a period of time and then was approached by a gentleman by the name of Bob James, who was forming a new brokerage idea in St. Petersburg, Florida called Raymond James and Associates. And so Dale accepted the offer to join the firm and started working within the Raymond James operation as a money manager. At Raymond James, he was their first money management solution for clients, and one of the things that they developed, which was a strong model that we see today, was creating a network of independent investment advisors around the country. And so they formed a subsidiary called Investment Management and Research, and Dale then supplied the money management solution to many of those firms across the country. At that same time, and this was in the 1970s, he started promoting the idea of using a fee only rather than a commission-based strategy. And so he felt that it was the one way you could be on the same side as the client. So he was a great pioneer in promoting that movement. He also, having achieved a lot of success himself, was able to loan some monies to Raymond James over time in those early days when they were getting started up. And fortunately, Raymond James repaid those loans with stock. So Dale became one of the largest shareholders of Raymond James and Associates and maintained that relationship up until the mid-'80s. The idea that the stockbroker was going to make money based on the number and size of trades that could be placed sometimes put them at odds with the client objective, particularly if the stock market was going down. The stockbroker was making a lot of money and sometimes even more money when markets were going down than the client was making. And the fee, which is scaled based on the asset being managed, the fee would decline as well during times of market contraction, so that you were always having the same impact on your revenue flow as the client was having on their asset. So he felt that just lined you up with the client's objectives more closely. Dale was an early innovator and promoter and leader in terms of promoting fee-only investment management services. In the early 80s, Dale started thinking about his own succession plan, and his son-in-law joined the practice in 1980. He'd been an officer in the Marine Corps and started learning the trading techniques. It was also in the early 80s that I met Dale. I had been the director of finance for a corporation that Dale served on the board for, and he saw what I was doing with the personal computer as it was coming out about that same time. So the ability to do some sophisticated financial modeling was a greatly enhanced capability over the old mainframe and IT department structure that had been in place. And he saw, again, some real possibilities for that in the investment world, which was very much mainframe and terminal based at the time. So he asked if I'd be willing to join the firm, and I did in the mid-'80s. And at that point, started taking some leadership role in the firm. His son-in-law and I bought the firm in its entirety in 1987 when Dale retired. And we have been very technology-based, always employing cutting-edge technology ever since. And that was something that Dale saw as real important to the firm's own capabilities and capacities. In 1987, concurrent with his retirement years, just before his retirement, Dale made the decision to leave Raymond James & Associates and become independent. And so at that time, we became an independent investment advisor and also affiliated with another firm in Charlotte, North Carolina, Interstate Johnson Lane, who had a similar network of independent investment advisors. And so that continued to be our practice focus. And we were employing both the covered call writing strategy and a managed account program, which was just using the same stocks that we would select for the covered call writing strategy. So we had expanded to building equity portfolios at that point. One of the frustrations that we had with building equity portfolios was the volatility of the portfolio, the lack of the ability to get really broad diversification in smaller accounts. And it seemed that the investment research that we would buy wasn't really that accurate. We couldn't pin our future on any of the advice it seemed that we were getting. So we started doing research into perhaps using mutual funds and building portfolios of mutual funds that would target specific risk parameters that we identified as appropriate for the client. We ran into a problem with the mutual funds as well, in that as we would look at what they said they would do and what they actually did, there seemed to be a lot of drift over time. So we ran into a real problem of trying to construct portfolios of mutual funds that were available to the public at the time, because they just seemed to change their stripes all the time. And that's the same point at which we read some of the first research that came out from Fama and French, talking about the three factors of risk. And that was tremendously helpful in forming the portfolios, but again, we didn't have a good implementation strategy until we found DFA, which of course was related to the Fama and French research, but we didn't know that at the time. So we encountered the research of Kenneth French and Eugene Fama, and who were both at the University of Chicago at the time, and their research paper on identifying the factors of risk. This gave us a really good roadmap for portfolio construction, but we still had the implementation difficulty of dealing with the mutual funds that were traditionally available, because they seemed to keep changing the ingredients. So it's like we could come up with a really great cake recipe and somebody kept messing with what was in the flour jar. Shortly after that, we became aware of dimensional fund advisors and their family of funds that were based on and constructed to the concepts that were identified by Eugene Fama and Kenneth French. And this all of a sudden gave us a way to implement in an efficient fashion. So we formed a relationship with dimensional fund advisors at that time.